The invisible cage. You wake up, go to work, earn money, and think you're free. But you're not. Every dollar you earn, every transaction you make, every savings account you open, it all flows through a system designed 150 years ago by three men who built a cage so sophisticated, most people don't even know they're trapped inside it. This isn't about conspiracy theories. This is about documented meetings, signed contracts, and deliberate design choices that locked humanity into a banking system where escape isn't just difficult. It's structurally impossible. And once you see how they built it, you'll understand why 8 billion people have no choice but to participate. Let me show you the three architects, the three innovations that built the cage, and why even if you wanted to opt out completely, the system won't let you. Before 1865, banking was local and fragmented. You put gold in a vault, the banker gave you a receipt and you could redeem it whenever you wanted. Different banks issued different currencies. Some were trustworthy, others weren't. But you had choice. If you didn't like one bank, you used another. If you didn't trust banks at all, you kept gold under your mattress. The system was messy, but it was escapable. Then came the Civil War, and everything changed. The U.S. government needed money desperately. Treasury Secretary Salmon Chase had a problem. The government was spending $2 million per day on the war. Tax revenue couldn't cover it. And borrowing from hundreds of different banks with different currencies was chaos. Chase's solution was revolutionary. He pushed through the National Banking Acts of 1863 and 1864. The legislation did three things that changed everything. First, it created nationally chartered banks with federal oversight. Second, it imposed a 10% tax on state bank currencies, effectively killing them and forcing everyone into the national system. Third, and this is critical, it required national banks to buy government bonds as reserves. Here's why that last part matters. Banks could only issue currency if they held government debt. The more bonds they bought, the more money they could create. This tied the money supply directly to government borrowing. It was brilliant for the government. Every bank became a forced buyer of government debt. But it was catastrophic for freedom, because now you couldn't escape. Before this, if you didn't trust banks, you used gold or alternative currencies. After this, there was only one system: national currency backed by government bonds, managed by federally chartered banks, and enforced by taxation that destroyed alternatives. Within a decade, 1,500 national banks existed. State banks either converted or died. And every American was forced into the system because there was no other way to conduct business. But Chase's system had a flaw. Banks still operated somewhat independently. They could still fail. Panics still happened. The cage was built, but it had gaps. It took two more architects to seal them completely. And what they did was even more disturbing. Because they didn't just eliminate alternatives, they made it impossible to even imagine life outside the system. The cage was built. But it wasn't locked yet. That came next, in a secret meeting that most Americans still don't know happened. The secret meeting, November 1910. 7 men boarded a private train car in New Jersey. They used only first names, no last names, no titles, nothing that could identify them. They traveled in secret to Jekyll Island, Georgia, to a private club owned by J.P. Morgan's associates. For 9 days, they designed the architecture of American banking. And what they created wasn't just a central bank. It was a mechanism to eliminate every escape route from the financial system. The men represented 1/4 of the world's wealth: Senator Nelson Aldrich, Assistant Secretary of the Treasury Arthur Shelton, Frank Vanderlip, President of National City Bank, Henry Davison, Senior Partner at J.P. Morgan, Charles Norton, President of First National Bank, Benjamin Strong, Head of Morgan's Bankers Trust, and Paul Warburg, Partner at Kuhn, Loeb & Company, who'd spent years studying European central banks. They knew Americans hated central banks. The first and second banks of the United States had been destroyed by popular opposition, so they disguised it. They called it the Federal Reserve System. 12 regional banks, not one central authority. A board of governors appointed by the president, not controlled by bankers. It looked decentralized, public, democratic. But the structure was a masterpiece of misdirection. The regional Federal Reserve banks were privately owned by member banks. Those banks elected 6 of the 9 directors of each regional Fed, and the most powerful Fed, the New York Fed, was controlled by the largest Wall Street banks. The same banks whose representatives designed the system at Jekyll Island. Here's what they built and why it sealed the cage completely. The Federal Reserve was given monopoly control over the money supply. No competing currencies allowed, no alternative systems permitted. If you wanted to participate in the American economy, you used Federal Reserve notes, period. But the real innovation was the elastic currency. The Fed could expand or contract the money supply by buying or selling government bonds. When the Fed bought bonds, it created new money. When it sold bonds, money disappeared. This gave them total control over economic conditions. Boom or bust, decided by bond purchases. And here's the trap. Every dollar in your wallet is created as debt. The Federal Reserve creates money by buying government bonds. That money enters circulation as government spending, but the bond remains on the Fed's balance sheet. The government owes the money back plus interest. This means the entire money supply is borrowed into existence. There are no debt-free dollars. Every dollar represents someone's obligation to pay interest. And since interest isn't created when the loan is made, there's never enough money in the system to pay off all debts. Someone always defaults. Some bank always fails. Some business always goes bankrupt. It's mathematical. The system requires perpetual debt and perpetual failure. The Federal Reserve Act passed in December 1913. Most congressmen didn't understand what they were voting for. President Wilson signed it and later allegedly regretted it, saying he'd unwittingly ruined his country. But it was done. Now the cage wasn't just built. It was locked. You couldn't opt out of the banking system because there was no alternative currency. You couldn't avoid debt because money itself was debt. And you couldn't escape the boom-bust cycle because the Fed controlled it deliberately. But there was still one escape route: gold. If you didn't trust paper money, you could hold gold. It was outside the system, valuable independent of banking. That was the last gap in the cage. And in 1933, Franklin Roosevelt closed it, with an action so brazen it's still shocking today. The gold confiscation, April 5, 1933. President Franklin Roosevelt signed Executive Order 6102. With one signature, he made it illegal for Americans to own gold. Not just illegal to hoard it or refuse to spend it, illegal to possess it at all. Citizens had until May 1st to surrender their gold to the Federal Reserve in exchange for paper dollars at $20.67 per ounce. After that, possession of gold was a federal crime punishable by 10 years in prison and a $10,000 fine. That's $230,000 in today's money. The official reason was the Great Depression. Roosevelt claimed gold hoarding was preventing economic recovery. Banks were failing, people were scared. They were converting paper money to gold and hiding it. This drained gold from the banking system and prevented the Fed from expanding the money supply to fight deflation. But here's what really happened. The government needed to devalue the dollar to inflate away debt and help debtors. But they couldn't do it while citizens could convert dollars to gold at a fixed rate. As long as gold was redeemable, the dollar's value was anchored. So Roosevelt broke the anchor. He confiscated the gold, made it illegal to own, and then immediately revalued it. In January 1934, the Gold Reserve Act set gold's official price at $35 per ounce. That's a 69% devaluation overnight. Everyone who surrendered gold at $20.67 lost 40% of their wealth instantly. The government stole it through forced exchange at the old price, then revalued it at the new price and pocketed the difference. But the real purpose was darker. Gold was the last asset outside the banking system. If you didn't trust banks, you held gold. It was money that existed independent of debt, independent of the Federal Reserve, independent of government control. By making it illegal, Roosevelt eliminated the final escape route. Now you couldn't opt out. You couldn't hold alternative money. You had no choice but to use Federal Reserve notes, participate in the banking system, and accept whatever inflation or deflation the Fed imposed. The cage was sealed, not just locked but welded shut. And here's the mechanism that made it permanent. After confiscation, gold became a tool of international settlement only. Governments and central banks could hold it and trade it, but citizens could not. The Bretton Woods Agreement in 1944 formalized this. The dollar became the world's reserve currency, backed by gold at $35 per ounce, but only foreign central banks could redeem dollars for gold. American citizens were locked out of the system entirely. This lasted until 1971, when Richard Nixon closed the gold window completely. Foreign governments were redeeming too many dollars for gold, US. Reserves were depleting, so Nixon ended convertibility. The dollar became pure fiat, backed by nothing but government force and Federal Reserve manipulation. And gold ownership was legalized again in 1974, but by then it didn't matter. The monetary system was completely untethered from any physical asset. Here's why this matters for you today. Every dollar you earn exists only because someone borrowed it into existence. Your savings account isn't money held in reserve. It's a liability on a bank's balance sheet, backed by loans the bank made. If everyone tried to withdraw simultaneously, the money wouldn't exist. It's called fractional reserve banking, and it means your deposits aren't actually there. Your checking account balance is just a number in a database. The bank doesn't have your cash in a vault. They lent it out 9 times over to other borrowers. The system works only because people don't withdraw simultaneously. It's musical chairs with your money, and there aren't enough chairs. This is the system the 3 architects built. Chase created the national cage in 1863. The Jekyll Island group locked it in 1913. Roosevelt sealed the final exit in 1933. And now, 90 years later, you're living inside it with no way out. But the trap goes even deeper, because what they built wasn't just a national system, they exported it globally. The Global Trap, July 1944. While World War II still raged, 730 delegates from 44 countries met at the Mount Washington Hotel in Bretton Woods, New Hampshire. Officially, they were designing a post-war monetary system to prevent another Great Depression. Actually, they were exporting the American banking cage to the entire world. The conference was dominated by 2 men, John Maynard Keynes, representing Britain, and Harry Dexter White, representing the United States. Keynes proposed an international currency called the Bancor, managed by a global central bank. It was rejected. White's plan won. The US dollar would become the world's reserve currency, backed by gold at $35 per ounce. And 2 institutions would enforce the system globally: the International Monetary Fund and the World Bank. Here's what this meant in practice. Every country needed dollars to conduct international trade. To get dollars, they had to export to America or borrow them. And to borrow, they had to join the IMF system, which required opening their banking systems to international standards. The same standards the Federal Reserve operated under. Within 2 decades, every developed nation had adopted the American model. Central bank controlling money supply, fractional reserve commercial banks, government debt monetized through bond purchases, and citizens forced to use the national currency with no alternatives permitted. The cage wasn't just American anymore. It was global. But the Bretton Woods system had a fatal flaw. Foreign governments could still redeem dollars for gold. And as America printed more dollars to finance the Vietnam War and domestic programs, foreign central banks started demanding gold. By 1971, US gold reserves were depleting rapidly. France alone had redeemed $3 billion for gold. Germany and Switzerland were lined up next. On August 15, 1971, Richard Nixon announced the US would no longer convert dollars to gold. The gold window closed permanently. This should have collapsed the system. Without gold backing, why would anyone accept dollars? But it didn't collapse because there was no alternative. The entire world economy ran on dollars. Every central bank held dollar reserves. Every international contract was denominated in dollars. Every country needed dollars to buy oil because OPEC had agreed to price oil exclusively in dollars. This was the final innovation. The petrodollar system. In 1974, Henry Kissinger negotiated a deal with Saudi Arabia. They would price oil only in US dollars and invest their oil revenues in US Treasury bonds. In exchange, America would provide military protection and weapons. Within 2 years, all OPEC nations joined the arrangement. Now every country needed dollars not just for trade, but for energy. And to get dollars, They had to either sell to America or borrow from the IMF. The dollar became the only currency that mattered, and the Federal Reserve became the de facto central bank of the world. Here's how the trap works today. You earn dollars, you deposit them in a bank, the bank lends them out at interest. Those loans create more deposits in other banks, those banks lend again. The money multiplies through the system, but it's all debt. Every dollar in existence is someone's liability. If you try to opt out, you discover it's impossible. Try buying a house without a bank. Try starting a business without credit. Try saving wealth outside the banking system. You can't. Even if you buy Bitcoin or gold, you have to convert it through the banking system to use it. The cage is total. And here's the final mechanism. Every 10 years, like clockwork, there's a crisis. 1987 stock crash, 1998 Asian financial crisis, 2000 dot-com bust, 2008 subprime collapse, 2020 pandemic shock. Each time the solution is the same. Central banks create more money, buy more bonds, expand more debt. The system never contracts. It only grows, because contraction means defaults, and defaults mean bank failures, and bank failures mean systemic collapse. So the Fed keeps printing, keeps buying bonds, keeps expanding. The money supply grows, debt grows, and everyone becomes more trapped because there's no way to pay it back. The interest alone exceeds the money supply. This is the cage the three architects built. Chase locked Americans in. The Jekyll Island group automated the locks. Roosevelt removed the exits. And Bretton Woods exported it globally. Now 8 billion people live inside it. You can't opt out, you can't use alternative money, you can't escape the boom-bust cycle, and you can't avoid debt because money itself is debt. The system isn't broken, it's working exactly as designed. You were never meant to escape. You were meant to work, borrow, pay interest, and stay inside the cage until you die. That's the truth they don't teach in school. The banking system isn't a tool for your benefit. It's a mechanism for control. And the architects built it so well most people never realize they're trapped.